We have Alok Agarwal, who's now joining us, of Alchemy Capital. Alok, good to have you back on the program. Thank you for your time. I've got your holdings by weight as of the 31st of May. And I don't know when you bought BSE. BSE is the highest weighted stock. I don't know when you bought it, but I was till at least about 10 days back when I looked at it, it was the #1 performing stock in the NSE 500 list. In terms of large stocks above a certain market capitalization. I don't know if you've ridden the full wave, full up move. We had the BSE management with us, by the way, today. Seemed pretty unfazed, saying that, change in expiry day doesn't necessarily have to hurt. There are other levers they can use to protect market share, especially in the option side. Just wanted your thoughts here.
Yeah, sure. Hi, Prashant. A pleasure to be here. Yes, with this particular stock, we have been able to participate for a major part of the rally. I cannot say that I have bought exactly at the bottom, but for more than a 1.5 year holding, I can't be complaining with the rally in the stock. And also to a large extent agree with the kind of change in the expiry date. Of course, Tuesday was a more preferred expiry date. Coming to Thursday, the back of the envelope kind of calculations show that a 22% market share may come down to an 18%. That's what the consensus numbers are also reflecting. But yes, with the kind of better products, better execution, and innovative strategies being used, I would say that, yeah, there's a good chance of more and more growth coming this way in this particular part of the markets.
Okay, Alok, hi, good afternoon. Great to have you on the show. So, give us a sense where going forward, next, 1 to 2 years at least, you see substantial clarity on earnings growth, because the market always wants to reward, the growth centers or the growth companies. So, if you could identify some pockets where you're beginning to see that, where you perhaps will take a bigger allocation call as well at some point.
Surabhi, I couldn't agree more with you. Yeah, it's the earnings growth that gets rewarded. If you look at the major index heavyweight sectors, the sectors also actually did very well in the prior decade. Those sectors' growth are actually not coming through. They're actually lagging the nominal GDP growth also. The likes of oil and gas, the banking space, the FMCG, and the IT. But the growth is coming from elsewhere, which are not really a part of the major indices. So in consumer discretionary space itself, be it the hotels, to an extent aviation, in the whole tourism basket itself, some part of retail, even in pharmaceuticals or other healthcare, the hospital segment is doing very well. Within financial services, we are seeing some platform companies and especially the capital market players are doing extremely well. So there are pockets of growth emerging, but they are not really coming down from top down, the larger segments. That's why we are seeing those segments not really doing too well. Even in the manufacturing and industrial space, we are seeing good growth coming from the power side, the defense side, and with the government's focus continuously on increasing the manufacturing share in the GDP, we might have more and more of such growth contribution coming from the cyclical side of the markets.
No, absolutely. And kudos to you for having identified some of those pockets and opportunities, Alok, because if I go back to the top holdings, and you mentioned capital markets, of course, BSE we've discussed. You've also had MCX. You mentioned power and Hitachi Energy and GE Vernova. Some of these stocks have done so well, and you have them in the portfolio. Also, Massgaon Dock, which is, I think, almost 5.7% of your holding. On defense, a little more broadly, do you think the stocks are already pricing everything to perfection? You already have the stock, so that's great. But is there any sense in buying afresh into any part of defense?
A lot of times during the investment journey, we come across certain groups, certain sectors where the runway of growth is pretty long. I think defense falls in that bracket. Till a few years back, India was completely dependent upon imports primarily. Although we spent a substantial amount of our budget inflows into the defense side, almost 50%. And half of that is to go on the admin and the salaries and the remaining in the imports. Over the last few years, we saw some shift happening towards the import substitution. And especially of late in the last couple of quarters, especially, we have kind of demonstrated our capabilities in terms of exports also. And especially in the era that we are living right now, where skirmishes, short-term wars keep happening in various parts of the world, the demand for such things is on the defense side is actually going up. The broad numbers speak that roughly the global defense expenditure is close to $2.5 trillion or so. And with this kind of wars erupting every now and then, I wouldn't be surprised that the allocation on the defense side globally goes up. Even if it goes up to, say, $3 trillion or so, a small portion of that, even 1% of that coming India's way as export opportunity, there's a long runway of growth in this segment in our view. The players are showing their capabilities in terms of execution as well. So you're absolutely right. So we're looking at the near-term earnings, the valuations will look stretched, but given the longer-term higher growth run rate, this sector will keep on giving opportunities of finding winners and riding them.
Yeah, no, absolutely, and I think it's an interesting portfolio. Actually, it's a portfolio which has done very well. You know, holding this portfolio, I'm assuming, Alok, you've done very well. It's a mix of power. You've got exchanges, not just BSE, which we discussed, but MCX as well, defense. You got Interglobe. I mean,
he's got all the winners.
Yeah, Prashant, I can't be complaining, but as a fund manager, we keep getting greedy. So the more you get, the more you want to do it right. And of course, there are times when you don't get it right. And markets are volatile. Certain news flows or certain actions do happen. And but the kind of method that we have been following is more like a binary method, wherein something that is not really growing too much or isn't really performing, especially in terms of earnings growth, and the visibility is lacking. So having the courage of not taking them in the portfolio at all, rather than playing through a minor underweight, that also helped us.
I mean, what I can see, maybe you do own them in small sizes, is you don't own any financials, any banks, etc. Right?
So, yeah, Prashant, financials is the highest proportion of the fund. It's around 29.5%. But you're absolutely right. There's not a single bank out of that 29.5%.
Okay. Oh, 29% is financials, but no banks. Okay.
It's predominantly
you counting
the capital market.
Yeah. Okay. The MCX and BSE and others, basically. Non-banks. Exchanges, capital market plays largely.
So
a couple of lenders, but banks, but primarily through the capital market plays are one or two of the platforms.
So, Alok, just to understand the style and the approach, I mean, you look at stock selection through the quantitative lens, right? I mean, quant strategies is something that you look at or use as part of your selection process. Is that right?
I do look at the quant strategies. I've been an active fund manager as well. So looking at the fundamental side of it and as well as the quality side of it is an important aspect. Most of these stocks, most of the portfolio has been constructed on the rule-based investing. Do look at a combination of the quality parameters, the growth parameters, as well as the price action parameters. Combining them in response to the kind of market we are in, as in case we are in a slightly more stronger market, so price action factors have a much larger role to play. And in a slightly more defensive or a risk-off market, the quality factors have a larger role to play. But
I brought up this point.
Right.
Absolutely, Alok. And that's why I really brought up this point because, I mean, it's been fantastic. Like we've discussed, some of your top holdings have done so well. So from here on, and if I ask you to wear your quant specialist hat for a bit, then, we've had a momentum-driven market, then value stocks did really well. But say for the next 12 months for your portfolios, from a quantitative aspect, which are the factors that you'll pay perhaps, the greatest amount of interest to or the greatest allocation to?
It's very counterintuitive. So we'll notice that the last 3 months, the markets have rallied so much. So an expected answer would have been that the momentum-driven factors would actually rule the roost. But the fact is, it's the visibility of growth that is actually happening to be rewarded, or maybe some punishment happens when the visibility is lacking. So it's the visibility of growth, a higher growth than the overall nominal GDP growth. We recently had the concluded financial year, and our corporate earnings to GDP has hit a 17-year high. So to be able to outperform, one needs to have stocks and sectors that are growing much faster than the nominal GDP. And that visibility is the one that is more important in this ever-changing world, a dynamic world. So that's the key factor in our view, which is actually getting more rewarded.
Okay. All right, Alok, great conversation. Thank you very much for joining in and giving us perspective on a whole range of issues. Of course, some of the sectors as well, where you have overweight, so you have large positions. So that's a word coming in from Alchemy.